Hello my dear students, how are you all? Hope you all are doing good. So our strategy is to complete within this 4 days our entire syllabus of accounts. So what I thought is, within one chapter of share capital you get maximum marks. So let us just cover that share capital. So conceptually I am going to teach you share capital chapter, then we'll proceed to MCQs, as well as partnership chapter we will learn conceptually and then we'll proceed to the MCQs. Okay, so let's get into the video. Okay, so in the share capital chapter you have to understand certain basic concepts in the chapter of shares. So these are the basic concepts. So we'll go through that. First of all, what is the meaning of share? Share is a part or the unit of capital in the company. Now, if the company wants to raise 10 lakhs, it will not collect that 10 lakh with one person. It will divide and split that 10 lakh into equal parts of 10 rupee each share or 100 rupee each share. It will divide and it will collect the money from the general public. So people will invest in that equal smaller amount of the share value, like how much ever they want to invest, they will invest in that. So capital is split into equal parts called shares. It can be valued as 100 or rupees 10 depending on the company. Okay, so this is the meaning of share. So when you invest in share, what is the return you are going to get is dividend. The profits of the company will be divided and it will be given to the shareholders who has invested. Okay, so now we'll proceed to the types of shares. Okay, the two types of shares are equity shares and preference shares. I will just give you the keywords of all of this. What is the meaning of equity shares? If you want to become the owner of a joint stock company, you have to invest in equity shares. Equity means it has ownership on the assets and liabilities of the company. If you want to become the owner, you will invest in equity shares. So you will have the ownership rights on the company's assets and liabilities. And also if you are the owner, you have to face the risk. You have to bear the losses. So you cannot expect a fixed rate of dividend. You cannot expect a fixed rate of returns. Then, if you are investing in equity shares, the money which you invest will be given back to you only when the company is closing. Till then the company will retain that money with them. If you want to sell the shares in the stock market, you can of course sell. But then the investment which you are making will be there in the joint stock company. And it will be paid only during the liquidation of the company, when the company is closing. Okay. So what is the meaning of preference shares? If you don't want to take risk, you want to be in a safer position, getting a small amount of returns but a fixed returns, then you can go for preference shares. Preference shares are those shares which gives you fixed rate of dividend. If you want fixed returns, if you don't want to take risk, you can invest in this preference shares. So fixed dividend will be given on these shares. Why are these called preference shares is, if you are a preference shareholder, you get preference, importance in the payment of dividend and settlement of claims. Now, whenever there are profits of the business, the dividend will be first paid to you if you are a preference shareholder. Then if anything is left over, will be paid to the equity shareholders. In case of higher profits also, first it will be paid to you, but the fixed rate will be paid to you. But for equity shareholders, the higher whatever profits are there, they will be enjoying. If there is a loss, equity shareholders will face a loss. Okay. And settlement of claims also, once the company is closing, they will first pay the amount to the preference shareholders. If anything is left out, it will be paid to equity shareholders. So these are the two classes of shares. Equity shares are the ownership shares which has ownership on the assets and liabilities. No fixed dividend, very high risk. Preference shares are those who get preferential right over payment of dividend and settlement of claims. Okay. Now we'll quickly move towards the classification of capital. Now we tell the joint stock company raise money through shares by offering shares of smaller denomination. How is that done? What is the process? What are the kinds of share capital? So we are going to see how is it classified. Okay. Please remember this. According to part 1, schedule 3 of the Companies Act 2013, this is how the classification of shares are. Of authorized capital. If we are starting a company, those who start the company are called as promoters. Now promoters will act as the directors till the actual directors are appointed. Directors are the person who manage the joint stock company. Now if we both are directors, we both will jointly think how much would our joint stock company require the capital to the maximum extent. The maximum amount of capital that we may require in our joint stock company will be decided by us. So that will be mentioned in the document of the company called Memorandum of Association. So authorized capital is the maximum capital that a joint stock company can raise, and that will be specified in the Memorandum of Association. Who will be specifying it? The acting directors will be specifying it. Okay. Authorized capital is also called as nominal capital and registered capital. Please remember this. It may come for MCQs. Then the next type of capital is issued capital. If authorized capital is the maximum amount of capital that a joint stock company can have, among that, what is our financial requirement? How many shares are we supposed to issue to the people to collect the money? So we will think about our financial requirement and we will offer shares to the public to collect the money. That is called as issued capital. So issued capital also includes for consideration other than cash. Now for example, you purchase any asset from someone. In return, instead of paying money, you will pay through your company shares. If you offer the shares to the public, you will receive money. Instead, here you take an asset and pay them through your shares. Okay. So that is also included in the issued capital. Then subscribed by the signatories to Memorandum of Association. Now when a document of Memorandum of Association is created, that is the objectives documents of the company. In that, the signatories, whoever are signing as acting directors, they have to purchase our company shares. To qualify as directors, they have to purchase our company shares. So that is a part of issued capital. Then directors who buy as qualification shares. Qualification shares are also those shares. If you act as a director, you have to own the shares in that particular company. For you to act as a director, to get that qualification, you have to purchase the shares. So these qualification shares are also a part of issued capital. So what are the part of issued capital? If you give your shares for purchasing any asset, if the shares are given to the signatories who are signing in the Memorandum of Association as acting directors, then if a director buy the shares for qualification shares, all of these are part of issued capital. Okay. Now we'll proceed to the next one, subscribed capital. Now if you offer the shares to the people, it is not that exactly they buy whatever you issue. You may issue 9 lakh shares, but the people may buy only 5 lakh shares. They may buy only 8 lakh shares. They may apply for 10 lakh shares. So whatever the people come and buy is subscribed capital. Whatever you sell is issued capital. Whatever people buy is subscribed capital. Okay. So subscribed capital is bought by the public. In this we have two types of subscribed capital. One is subscribed and fully paid up, subscribed and not fully paid up. What is this fully paid up is, if the share value is 100 rupees, if I ask the shareholders to pay 100 rupees, everyone has paid. That is, people have bought and fully the share value is paid. That is subscribed and fully paid up. What is subscribed and not fully paid up is, I have asked them to pay 100 rupees, but they have given me only 90 rupees. This is subscribed and not fully paid up. Remaining 10 rupees which they haven't paid is calls in arrears. We have asked them but they haven't paid. So that comes under not fully paid up. And also one more type of capital also comes under not fully paid up. Now for example, if 100 rupee value of share, if I am collecting as 30 rupees on application, 30 rupees on allotment and remaining 40 rupees on calls, installments, among this only first two money I have asked, the last money I didn't ask at all. The uncalled, called is you are asking for it, uncalled is you haven't asked for it. I haven't asked the shareholders to pay 40 rupees. Even whatever is not asked, that too comes under unsubscribed and not fully paid. Since the share value is paid only for rupees 60 and not for entire 100 rupees, it comes under subscribed and not fully paid. Only when the total nominal value of the share is paid, it comes under fully paid up. If that is not paid, if it is partially paid, it comes under not fully paid up. The relationship that exists between these three types of capital are, your subscribed capital will always be less than or equal to issued capital. Whatever you offer, public can buy only to that extent. So it has to be less than or equal to issued capital. Issued capital should be less than or equal to authorized capital. For example, if we decide our maximum capital is 50 lakhs. If you want to raise entire 50 lakhs, if that is your financial requirement, you can offer this as shares. Issued capital can be equal to authorized capital, or it can be lesser than 50 lakhs. It cannot exceed 50 lakhs. So this is the relationship that exists between these three kinds of capital. Subscribed capital should be lesser than or equal to issued. Issued should be lesser than or equal to authorized. More than authorized capital, none of the types of capital can exist. Authorized capital is the maximum limit that the joint stock company can raise. So this is the basic concept about shares. Okay guys, we'll quickly meet in the next video with few other concepts of shares. Okay, thank you all for watching. Please do recommend to your friends, let them also learn. Thank you all, and if you haven't subscribed still, please do subscribe. Bye bye.